David Rubenstein, the founder, or co-founder, I should say, of Carlyle, also a colleague, has a show on Bloomberg, Peer-to-Peer. So, David, you spend a lot of time traveling the world, talking to important investors. You're also very much a DC guy, very connected inside the Beltway. What are investors around the world wanting to know about America at the moment with the midterms around the corner? And what are they worried about?
Well, I think the investors are worried about whether the United States might have an economy that slows down. The economy's been very good for the last 10 years, frankly. And maybe there's some concern that the slowdown in China could spill over in the United States. Maybe the tariff and trade wars or skirmishes might slow down the economy. Whether interest rates going up might slow down the economy. And whether if the Democrats were to gain control of the Congress, whether that would produce more fights with the president, and that could slow down the economy. So it's unclear. And
how do you as investors here adapt to that?
I think investors in Canada are particularly concerned about the U.S.-Canadian relationship. It has gone on a rocky start right now. I would say the president and the Prime Minister of Canada had a good relationship at the beginning, but it seems to be less good than it once was. And clearly the new U.S. MCA agreement has to be approved by Congress for it to go in effect. It's not clear that Congress will yet approve it.
Do you think they will?
I don't think anybody really knows, because I think it's unlikely Congress will approve it in the lame duck session. And then if the Congress is partially controlled by the Democrats may not approve it. They're not much different than the president on some trade issues.
Now, here at the Capitalized for Kids conference in Toronto, we've heard about private equity, we've heard about infrastructure, we've heard about private credit. It seems to me like there's a ton of convergence going on in the asset management industry at the moment. And just this morning, actually, we saw Franklin Resources make the deal for Benefit Street. Are we moving to a place now where sort of traditional asset managers and alternative asset managers, there's no longer really a distinction between the two?
Well, there is a distinction because alternative managers get higher rates of return, so that distinction hopefully will continue. But to be very serious, there's a consolidation because investors want to pay lower and lower fees, and the best way to get lower and lower fees is probably to have consolidation and get the scale, giving lower costs to investors. So there will be more and more convergence, and I think more and more traditional asset managers recognize that they can't charge the fees they used to charge, and therefore they have to get some kind of more synergies by doing more money under management, or they have to do something that's going to justify the fees that they historically got but no longer get as readily.
So if it is a question of growing AUM, does that just mean we're going to see more convergence?
Well, AUM doesn't automatically mean higher fees because, as we know, some people are now giving away products. They're letting people invest for free, no fees.
That's absolutely right. So one thing you've been a big advocate of is giving more people access to private equity. You have this mass affluence market, which is rated as being somewhere in the region of 7.5 trillion. How do you access that?
Well, right now, it's difficult for people who are not accredited investors to invest in private equity. If you're an accredited investor, there are vehicles you can go in for sums that are lower than the traditional ones that people put in private equity. But gradually, I think the U.S. government will say, if you're in a 401k program or an IRA, you can put some amount of money into a illiquid investment. And I think that will be okay eventually. The U.S. the U.S. SEC is looking at that, and I hope at some point they will say, yes, it's unfair that the people who have the lowest amount of money can't get investments that have the highest rates of return. So risk adjusted, I still think private equity would be better for low-income investors, but it has to get some regulatory relief.
But if you are going to bring those low-income investors into the market, how does the private equity industry go about actually educating them so they are sufficiently sophisticated to understand what they're investing in?
Well, there are materials that they can read, and obviously they'll have financial advisors. So typically the way it will be done is if you have a 401k, it's got $50,000 in it, you probably aren't going to make a decision by yourself. You're probably going to have T. Rowe Price or Fidelity or somebody giving you a platform of potential illiquid investments, and they will have been screened by Fidelity or T. Rowe Price or Vanguard, whoever it might be.
All right, let's talk about the front end of investing. You have this interesting dynamic in the market at the moment where you have a ton of dry powder, record levels of dry powder. You also have extremely high multiples in the public market, a lot of strategic interest. What happens? What has to give?
I can see we wouldn't take you out in the fundraising world to be the fundraiser for us. No, there is a lot of dry powder, but actually dry powder tends to get invested over periods of time because you typically have 3 to 5 years to invest the money, so it's a little misleading to say the dry powder is $2 trillion.
But a lot of it was raised 3 to 5 years ago.
But some of that's now been invested. Generally, in our experience at Carlyle, about 95% of the money that we raise, we do invest. And remember, you don't go to jail if you don't invest the money. You just don't. You just give the fees back and so forth. So I don't think the industry feels it has to invest every every single penny and do bad deals as a result of it. We're pretty cautious. Remember, our money is invested alongside the investors. I do think the dry powder will get invested. And one thing I'd like people to think about is this: 83% of all private equity dollars are invested in the developed markets, but that's now only 45 to 50% of the world's GDP. So you've got 17% of the dollars in private equity going into the part of the world that has 50% of the GDP. And gradually, you're going to see more and more money going into the emerging markets, and that's how a lot of the dry powder will probably get invested.
But does that also mean that the sort of risk profile of investments will creep up?
Well, the risk profile in emerging markets is theoretically higher, but if you go back over the last 5, 10, 15, and 20 years, the average rate of return on developed market private equity is roughly the same as emerging market private equity. The theory is it's riskier, but in the end, the rates of return are roughly the same. The risk might be slightly greater in some areas, but I think to say China is as risky as Chad is probably not true. We call China and India emerging markets, but these are gigantic economies without the same risk they had 25 years ago.
All right, so you've been through a few different financial crises in your career, or you've seen a lot of different cycles, I guess. We're at a position now where we have 7 times leverage. It's crept back into the market. I think something like 13% of the deals done this year had about that on it. How worried should we be about that? People say it's nothing like 2008 this time, but I'm sure in 2008, they said it's nothing like the last crisis. Well,
remember, the debt that is coming in is roughly about what we had before the Great Recession, not that much higher, but the terms are much more favorable. Before the Great Recession, about 30% of debt had no covenants. Now it's about 80 to 90%. So if there is a slowdown, I think the debt can be worked through, and I don't think you're going to see the defaults at the kind of pace you might have seen 10 years ago.
Now, we're in Canada. It would be remiss to not ask you about cannabis. Does Carlyle have any interest in getting into the pot business?
Well, we invest in Canada. We like investing in Canada. We are trying to buy another company in Canada right now. Hopefully we'll win it. And if we do, that'll add to the portfolio we already have. Canada, in my view, is a very good place to invest. You've got a very educated workforce. You have a very high GDP relative to other countries you might invest outside the United States. And in the end, you've got rule of law, you've got transparency, quality of exit opportunity. So I think Canada is an excellent place to invest. My only reluctance in talking about it is I don't want my peers to hear too much about how good Canada is, because they might come here and drive prices up. So actually what I should say is Canada is not a good place to invest. My peers should not invest here.
Can you give us any clue about what the company you're looking at here is?
I could, but I'd go to jail because I've signed NDAs and a whole bunch of other things. So no, but it's a typically good Canadian company with a very good market share in Canada, but also around the world.
But not in the pot industry?
I'm not going to get any further into it.
All right, let's switch over to your broadcast career, because that's a sort of a relatively new aspect of your working life. You have interviewed a ton of really interesting people. We were just talking before we went on air about the Jeff Bezos interview, which was one of my favorites. Who would be your dream interview?
Well, I've interviewed President Trump before he was president. I think that would be a good interview to have again. I'd like to interview a few people that haven't been available. The Pope hasn't been available. The Queen Elizabeth hasn't been available. Xi Jinping hasn't been available. But, hope springs eternal. Maybe I'll get them.
Last question. What makes David Rubenstein tick?
Well, I feel I came from very modest circumstances, got very lucky. I want to give back to my country. I enjoy what I'm doing. I just wish I had more years to do it. So now I'm racing to get things done. I call it sprinting to the finish line.